Oh, welcome into another daily editorial here on the KE Report. I'm chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. And Jordan, I want to start off with gold and with the at least short-term reversal we have seen here. Gold was heading down for most of September, and once we got into October, there has been a rebound. Now, there was quite a sell-off at the very end of September, but just in the last couple days, gold has shot up about $40. So my first question to you is that recent low that we saw in the spot market for gold at right around 1465. Do you think that's going to be the low here for at least a little while? It was close to 1450, a level that a lot of people were watching, but didn't quite get there. Do you think that is the low now for a while?
I mean, we'd have to define a while, but it's a while in terms of like days, and maybe a week or two. I think it's possible. But if we're talking about is that going to be the low for a couple of months? No way. I think gold eventually is probably going to test at least 1400 and might even dip to the 1300s. I mean, it is a good move in gold if you're just looking at gold by itself. It had a bullish hammer yesterday, a strong white candle today. It's back above 1500. But Corey, when you look at the rest of the sector, and specifically the gold stocks, they're not doing as well. Like if you look at the last couple of days and you look at the candles on GDX and GDXJ, it's just what I call weak strength. Yesterday, both ETFs, they closed well below the highs of the day. So I mean that's a sign when a market is not strong is when it's rising but it's unable to hold most of its gains. And today we're seeing another bearish candle, but we're seeing black candles. So the market gapped up, but since the open, it hasn't really gained that much with respect to the miners. And I mean, with gold's back above 1500, so it's not even that far from its peak. But if you look at GDX and GDXJ, they're over 10% down from their peak, so they're not even close. And that's just what happens when you're in correction mode and you're not in an impulsive advance and the market is not strong. You see this kind of weakness with respect to precious metals. You see gold being the strongest part of the sector, and that's what happens during a correction or a weak point, and that's usually not what you want to see. I mean, usually you want to see the miners acting better. And I know silver has had a pretty good day the last couple of days following gold, but I mean, the silver stocks are definitely lagging silver and gold. So I still think that in the bigger picture, we're in a correction. I mean, the move in gold is nice. It probably has something to do with the stock market, but I know we'll get more into it later, but I just think what this is telling us is we're not, we might see a cut in October, but we're not headed for, multiple cuts in the short term, I guess you could say.
All right. Yeah, it's very interesting. Just using today as an example, we have gold that just continues to get a buy throughout the day. I look at the Kitco chart and it's gone up, up, up throughout the day. But then, yeah, you look at GDX, GDXJ, and they opened so far at their highest levels and have been choppy sideways to even a little bit down for today. And you look at SIL opened, gapped up at a high of its day, and right now is only up about 0.5%, and that's with a silver move that is up over 2%. So it is still very much the actual metals leading the price higher, which I think all goes to kind of a fear trade, and that balances out in the fact that money flows into the precious metals. So I know the bulls are encouraged by these moves, but quite frankly, when you look at the stocks, they are not telling the same message. Let's talk about how the US markets are reacting though, because those are looking pretty much the exact opposite as gold. They continue to sell off. The Dow is down 2%, over 500 points. S&P down almost 60 points, which is close to 2%. We are seeing an outperformance of gold compared to U.S. equity markets, so that is positive, isn't it? But do you think that the U.S. markets are getting a little bit too overdone here to the downside?
Yeah, I'm not sure, but I do think we should note, and it's something I was talking about several weeks ago. If we're looking at capital flows, with respect to markets, a lot of money has already taken defensive action. A lot of money already moved out of stocks and went into bonds and gold. And I know that's hard to believe given how well the S&P held up. So I don't think the stock market is at risk for a big drop. I mean, it's possible that this sell-off could continue. I'm not that keen on it right now, but I just think that, Corey, if this was a more significant sell-off in the S&P, we would see even stronger action in the gold to S&P ratio, and we would see the miners acting well instead of selling off. So they're stuck in this corrective mode, and even if the Fed cuts in October, I just don't think it's going to be enough to trigger another new up leg in precious metals. I mean, if they cut, it's possible they could, perhaps the miners get more of a bounce and they get close to their recent highs. But what the market action is telling me, at least, that if we cut, like, that will be the last cut for a while. And I just think that, looking at this corrective action of the miners, the precious metals are not going to make that next impulsive leg higher. One of two things has to happen. Either the market thinks the Fed is going to cut rates down to 1% or 0.5% again, or they don't cut, but inflation expectations start increasing. And that second one takes a little bit longer to happen. That's my read on the situation. I mean, normally the S&P starting to crack a little bit. Normally that should be very bullish for precious metals. And we see gold holding up very well. But again, the struggles of the miners, the struggles of the silver stocks, that's telling us that, we're not about to see a new impulsive leg higher in this big breakout move in GDX.
Now, what about those bulls that say the stocks will play catch up here? If gold can, let's say, hold back above 1,500, give a little bit more confidence to those traders on the sidelines, then maybe more money will flow into the stocks and they have a lot of room to play catch up.
I mean, if that's the case, then that's going to take a while. That's going to take at least several months. That gold would have to hold above 1,500 or 1,460 or wherever it is, and basically build a very bullish consolidation. I mean, that's if that for that to be feasible, basically we would need to see a bullish consolidation where gold goes sideways in a very tight range over the weeks and months ahead. I mean, the whole catch-up argument, I don't see that happening until the sector is really ready to make another impulsive advance. And just the way everything looks right now, I don't see that as imminent or even something that would happen in the next month or two.
Okay. So as much as this is a fear trade, couldn't there also be the argument made that if U.S. markets are selling off aggressively, then people just aren't that, or investors just aren't that willing to put more money at work into, what can even be considered risky stocks like some of the junior explorers or even the miners that consistently have underperformed? And that's why investors are simply just playing the simple gold price right now.
Yeah, I think we're reading into it. We may be reading into it a bit too much. I think that the market, the move that we had over the summer, the market discounted very aggressive Fed policy. And of course, the miners and gold hit important resistance levels. So naturally they pulled back. And now it's an issue of, I mean, the Fed looks like they're not going to cut as much that was factored in just a month or two ago, and so it's going to take some time, for the market, for the gold price and the gold stocks to find an equilibrium before, and in that time, the market is adjusting to the fundamentals, which are maybe the Fed is, maybe whether they cut or not in October, they're probably not going to do any cuts from November and possibly until March. So I think that's playing a bigger role. It's just the supply and demand of the market. We had a really strong move. We got up. We reached very significant resistance. So a correction was natural, and I think that's going to continue, whether it's a correction or consolidation. So the whole thing about safe havens and investors are looking for this and that. I think we're just reading into it a little too deeply. I know that that's our job as analysts, but I think we might be with respect to that question, we might be reading into it a bit too deeply.
Yeah, that's fair, Jordan. And you know what? You just need to look at how the markets have reacted recently, and even through a lot of the conversations I've had with other people. I think there's a lot of money on the sidelines, but it's definitely not rushing into the stocks right now. So it will still, I think, take some time. You're right, but it does still just all come down to Fed policy and expectations of Fed policy. You really couldn't get any more dovish than the markets were thinking earlier this year over summer when they were looking for 50 basis point rate cuts and all that kind of stuff. Those are very much off the table. And now the question is, how many more rate cuts for this year? Probably one, maybe two, but it more looks like one. And as you said, if inflation can start to pick up, then that can also be a driver. But with some of the recent data, especially in the US and around the world, man, the globe seems like it is still stuck in a slow growth at best environment. And that's one of the main considerations as well for potentially driving the precious metals, because right now it is very much a fear trade. But going forward, let's see how the stocks react, and also if the metals go through any sort of a corrective period or just a sideways consolidation. Not much more to say here, though, Jordan, but great chatting with you. Also, everyone click that link below. Go visit Jordan's website, The Daily Gold. Check out some of his free content. And also, if you're a trader, I highly recommend subscribing to his newsletter. Jordan, thanks for your time, buddy.